Thanks for tuning into Talking Point Unfiltered. I'm your host, Neeraj Shah. Our guest today is Kenneth Andrade, founder and CIO at Old Bridge Capital Management. Kenneth, so good talking to you. Thanks for taking the time out.
Thanks for having me on this show, Neeraj. Always a pleasure talking to you.
I can tell you the pleasure is entirely mine. And Kenneth, I would love to know if you reckon that the markets, the cycle that we may be in, because I know you study business cycles, you study market cycles. Are we at a point of time in the cycle wherein the chances of the cycle continuing positively are higher, or is it the other way around?
Okay, firstly, business cycles, and I hope market cycles follow the business cycles. Okay, so from a business cycle point of view, we've been at this place for a while. Okay, it's the best you've ever seen, and hopefully the best you'll ever see for some time. Right, and I've been on multiple forums, including having conversations with you on where we are from a financial standpoint. Okay, corporate India is at its best ever, et cetera, and I don't know if it can get better from here. Okay, but one thing they refuse to do is reinvest back into the cycle. Okay, and that's becoming a genuine problem right now. It started showing up. For the last 2 years. Even 2025 over 2024, you had a single-digit growth. 2024 over 2023, you had a single-digit growth, and this year doesn't look any significantly different. Always, of course, you have a couple of companies here and there that can pull a rabbit out of its hat once in a while, but I think unless you get back to a capex cycle, more so a private capex cycle, followed by whatever the government's doing, we're stuck in that point wherein single-digit growth and very high valuations for the kind of growth you drive.
Okay, and so Kenneth, it is very difficult to maybe hypothesize what will it take for corporate India to start investing, right? So does an investor wait for that turn to happen at some point of time to take advantage of a full-blown capex cycle, or does the investor move his vision elsewhere?
So let's look at it from an investor perspective, right? I don't think you're going to get significant out of the fixed income market. Okay, it's very tight in terms of where yields are right now, and I'm not too sure that we're prepped for another rate cut given where the global macros are, right? That's one. Second, if you go back to equities, and if you look at equity valuations in a very different perspective, if you're at 22 times earnings, or even 23 times earnings, 23 times earnings, you're at about 4.5 times cash flow yield, earnings yield. And if you look at earnings and all of that is becoming cash flow, you're at 4.5%, which is equal to where your bond market would be. Okay, and you hit parity out there. So between equity and fixed income, I don't think there's too much of a choice out there, which is where you've got alternative assets doing reasonably well. So I think that's what the choice is left with an investor. So there's no risk on capital from here. I don't think there's a risk on capital from here, but you've got to lower your expectation on returns. Okay. If I look at a 5-year compounded or a 3-year compounded or a 2-year compounded, that's as best as you're going to get for a while. Okay, I don't think it's going to cross that in a hurry so far, and you hopefully consolidate around this period of time. Okay, because if your broader economic parameters or broader growth rates are going to be single digit, to expect a company or two to become growing significantly faster than that, I think that is behind us for a while. Okay, so that's what an investor should do, and that's what an investor should look at. Wait for a period of time, see how it works out. Now, the capex cycle is also a little bit of it will come. In what shape and format, I don't know. It will come, and when capex actually comes up, it's usually followed by first free cash actually getting absorbed by the capex. Plus, then you leverage up your balance sheet also, right? So there's a new element of it all, which is debt coming in. And when you have a cycle like that expand itself, valuations tend to tear downwards. So your 23 times have to go to 20 times and 18 times and 19 times because there's a new participant in that EBITDA, which is interest cost, which is where the debt picks up. So I think we're stuck in that right now. Right now, no capex, elevated valuations. If capex comes back, you will get growth, but you'll still have valuations that would erode a little bit. So you're stuck for a while in this zone, and you'll have to go, and you'll really have to go stock picking to find an opportunity out there. Okay.
Got it.
So the market, my sense, has to get very narrow. And extremely narrow before we can see any signs of a full-blown revival all over.
And would the global investor be sensing this as well, because we are not quite exactly the recipient of inflows? I don't know if it's got to do an EM thing or is it very much an India thing. But I mean, you would be traveling the world, talking to people to put in capital as well. What is the feedback?
So India's got its capital cycle going on, right? We did extremely well for the last 4, 5, 6, 7 years, and there was lots of paper written about it. A lot of investors got extremely excited about it, and that's where it's taken us. So my sense is you'll have to wait your turn again.
Okay.
Okay, you got to wait your turn again simply because there are questions being asked out there. Is that you've got, I mean, most of them don't understand why you trade at valuations that you trade at. Second is, I think most of our companies, commodities or others, are at significantly higher, when I say valuations in this perspective, I mean the enterprise value per ton of every company that is enterprise value as a output of any product you manufacture is significantly higher than the rest of the world. So obviously the arbitrage of returns exists with other countries, and I think the only thing goes for us is the demographic dividend. Okay, but I had a very interesting question the other day by one of the investors saying that will India squander away its demographic dividend? I have no answer for that, honestly, but those questions keep cropping up. So at one, valuations are expensive. You got the demographics, but questions are being asked: should I pay these kind of valuations? And what is the execution risk am I taking for the cycle to play out?
Well, if we do squander with the demographic dividend, then we're looking at some major crisis coming up in the future with a lot of unemployment, and which could potentially be a problem. So I hope we don't. You seem don't have an answer, but
I don't think anyone of us have an answer. And as I've seen, I mean, we've all seen our country evolve, and we always find a way out of it, right? So it takes time. So it's an element of time. It's not about if and when. We will. The question is when.
When. Got it. Okay.
And how, of course.
So because there is not too much to choose from right now between fixed income and equities, maybe equities could be the answer, but then you got to dig really deep, prepare and go very bottom up, and do prepare for volatility or muted returns over a period of time. But there could be exceptions to this rule. I mean, I'm just trying to think that when you're constructing your portfolio, Kenneth, there are some market performers out there which you buy for stability, size, liquidity, what have you. And then there are some which will be the jokers, which you'll try to have in your portfolio because you believe that growth could be significantly high. And there are sectors out there, energy transition, EMS, etc. All of the managements are really talking big numbers. Where do you find this combination of high growth and reasonably okay relative valuations, if you will? I know I can't use the term cheap or good valuations because that's beyond us in HS.
So if you look at what we're trying to do is we're trying to exploit companies who are creating international franchises, because then you move away from the hardcore India's a growth market. Everything is in India. Companies are continuing to grow. Look at our demographics. I think we are a domestic economy, and a lot of investors have their home bias. This has got nothing to do with India, but a lot of countries have investors have their home bias, and we have ours. And obviously you've got the demographic dividend. But I think there are times where you can exploit the demographic dividend in terms of consumption, and you can use it for creating capacities, which are creating capacities and creating companies which focus on not just 3.5-4% of the world's GDP, which is India, but try and look at exploiting other opportunities out there. So you got to use it there. And you have to look for companies that actually will and somewhere create that international franchise. and that can give you domestic growth plus something more. Okay, so that's the only logical format we found out, or we've been running to break this. We like the domestic market at the valuations, but nothing on the other side. We've tried to look at very strong domestic franchises, and those domestic franchises are generating enormous amount of cash flows. How are they investing those incremental amount of cash flows to create franchises or to create marketplaces where they will have their advantages. Okay, so the most common places that we've seen it happening in tech, obviously services, IT services, and IT services are going to say mid single digit or low single digit kind of growth. So it's a fairly mature industries. Okay, in the recent past, you've had it happen with chemicals, and everyone was talking about, look, this is what's happening at chemicals. In the 2015, we had a small category in pharmaceuticals that did extremely well. That might resurface. Even chemicals might resurface itself. But here, the construct is not as easy, because at the other end, you've got to figure out if you have the cost advantage at your end. If you have the cost advantage, then you're productive and then obviously you got a product that you can take to the international, that you can find buyers across the world. So there are combinations of all of this that are at work, and we will see how some of our Indian companies, some of the Indian entrepreneurs actually exploit their cash-rich nature of business to get more market share across the world.
And this would be, I mean, in your portfolio at least, or maybe the opportunity overall, is it more in manufacturing-led businesses creating this outside, or is it services-led businesses?
You will find it all over the place.
But where are you tilting towards?
So you predominantly look at services, but a lot of manufacturing is also kicked up. I mean, we've got a fairly integrated automotive manufacturing setup. So obviously we're very good with engineering and metal forming and all the ancillaries put together, right? So that's one integrated chain that you have. You obviously have the pharmaceuticals and chemicals business that is there. So it's not that you're losing market share, but you're not gaining market share. It's not that you're losing market share, but you're not gaining market share. But you're out there trying to get incremental amount of clients, okay, and then within both those industries, you've got a service element to it all, which is fairly popular in today's day and age. Okay, so a lot of those businesses are also, which is the CDMOs that everyone keeps talking about. So that's also a very popular space, and that's gaining traction, and it's fragmenting at an extremely fast pace. So yes, so that's a services line front-ended by manufacturing. Then you've got the IT services and the GCCs that are being set up. So that's the element of where some element of demographics play a big role. Okay, so it's an element of both. I can't singularly put it that it's just one thing that's playing out for India.
Okay, so let's talk about a sector that has been debated quite a bit in 2025, or maybe all through its cycle, but 2025 because of the advent of AI, and that's IT services, ER&D, or the tech sector in India. Because you look at a lot of businesses cyclically, I'm trying to understand if you think of this as a cycle too, and if so, can you hypothesize the cycle for us as you see it from here on until the next 2, 3, 5 years, 7 years, as the case may be?
I will put it in financial terms, or at least hypothesize this in financial terms rather than saying how this industry cycle will play out. I think you won't break that growth pattern that is already sitting out there, which is mid-single digit levels. But there's a lot you can do on cost as far as all of this is concerned. Okay. So you can automate a lot of your costs. So automation or AI, as we look at it a little differently, can be used on your cost element to see how you can push down costs. Okay, while still hopefully maintaining a single digit top line growth, because I think that's where the advantages lie. So over the near term, it will still be a hybrid model. I don't think automation is going to take off without human intervention. And in the longer term, I don't have a crystal ball, nor I have domain expertise to see how some of these models play out.
Okay, but you're betting that there'll be mid-single digit or high single-digit growth coupled with operational efficiency, so better margins, thereby better maybe PAT, good cash flows, good dividend yields, what have you.
Yes, yes.
And therefore,
yes.
that makes the sector attractive.
Yes. Yes. So if I look at it from a perspective of margins, which is typically what everyone talks about, right? You got peak margins and you got trough margins. Okay. A lot of companies are trading at their bottom end of their margin cycle. So obviously, most CEOs or most operational guys on IT are just watching this number. So if you can just squeeze your margins a bit, you'll be back to peak cycle.
Very interesting. And would the same thought apply to, say, ER&D as a subset of IT services? Because there, I mean, there are some vertical specialists, etc., and everybody thought that with auto industry going the way it is, could there be problems? But we had, for example, Tata Tech coming and saying that, oh, things look very good from quarter 2. So, but I'm not restricted to auto ER&D. All I'm saying is ER&D as a bucket. Do you think there too?
It's a much wider bucket out there, and then there's a lot of work that can happen out there or will happen out there. So automotive is just one fraction of it all. So energy, all of those industries will fill into this cycle, because every industry will somewhere down the line need to get automated or need to get information at the push of a button. Right. So yes, there is an opportunity which is much wider than what you're seeing at this point in time.
Got it. Okay. So that IT services is one, or tech is one. Auto components maybe one as well. Wherein you also, I believe, March or April put up a fairly high purchase in a domestic auto company, though, right? So therefore, you're playing the global piece by auto components, but you like the domestic consumption space maybe for autos. Is it the valuation call, or is it a very bottom-up call?
So today, I think one of the data releases said that exports are at an all-time high in automotive. Okay, and if that's the case and one company leads it, then obviously you've established some strengths in that vertical or in that market. Until domestic growth doesn't pick up, cash flows continue to come from this one piece, which is outbound. So this is where I think we are in that cycle. So cash flows are good for the business. He's investing ahead of the entire curve. He's investing more capital than most of the other automotive cumulatively put together, and all of this is coming through internal accruals, and all of this is finding new marketplaces.
Point well noted. The other question is this whole mention about CDMO, right? Truly, Indian businesses making capacities. Some of them have built out now capacities. Maybe the time for order inflow comes in, but almost all of them without exception, are trading at some very steep valuations. So what's the argument here? Is it that growth will make up for the valuations?
I mean, the Indian market environment usually works that way. You price everything far ahead of the entire curve, right? So when it's all discovered and everyone knows what's going to happen, then you've got to pay the price for it. So there's no I mean, if there's anything secular, it's only valuation. But then you pay a lot of upfront premiums for this business to succeed.
Got it.
Okay, but we'll have to look at it. Let's say again, the opportunity in something like this is significantly large, because the numbers are out there. There's close to about $700 billion of drugs going out of patent between 2025, which is this year, to 2035. Okay, and then after one of the companies done one of these R&D deals, I think that's another place that will take capital in, because the opportunities out there are sizable in terms of, if you get it right, the cash flow back-ended.
That's true. Okay. Okay. So is again, just clarifying. So whatever positioning you may have done, have you taken a basket approach here, or is it a very, very bottom up, choose one company and ride with it type of an approach?
In all individual verticals in that space, we've taken a company specific. So we're not duplicating it all.
No. Okay, fine. Okay. You are one of the early identifiers of the real estate cycle. Have I read correctly that you believe now that the best may be behind it?
Um, that's an interesting one because this market continues to consolidate quite dramatically.
Yeah.
Okay, as I like to put it, the top 5 companies are developers. The rest are all contractors. I may not be right.
100%, yeah.
I may not be right, and idea is not to offend anyone out here. But if the consolidation at a national level, and this is a national level consolidation taking place, right? Then obviously the price points will be dictated by those 5 companies, and then there'll be some boutiques that will keep coming across the board. And that's how it is. So we'll have to wait and see how these companies evolve, because even today, in terms of total market capitalization, it's not a very significant part of the market yet.
Right.
Okay.
In no index representation either.
One is there, I think. DLF is there on the index? No. No. Okay. So I still think there is space for it to go. Okay, except for 1 or 2 companies which are cash flow positive, the rest are still sinking their balance sheet. I mean, they're still putting a lot of cash to work. So as I think I see it, real estate should continue to have price inflation. Real estate and real estate companies should continue to have price inflation. You'll see consolidation continue to happen. And if you see a knee-jerk temporary slump in the marketplace, you will see the top 5 or top 6 companies continue to get higher and higher market shares out there.
Okay. But are the best returns still behind? So if you can pick and choose one, yes, but the rising tide carrying all boats story, which was a part for real estate for 2-3 years, maybe longer, is that now behind us?
You will still, our sense is, you will still make above market returns on this.
Okay.
This is one industry, at least some companies or a larger part of the companies in this industry might still continue to grow faster than the broad economy.
Got it. Okay.
So yes, it's and I think 2 or 3 of these companies get cash flow positive starting this year or next year. So we're pretty close to that. And then they just invest in perpetuity unless they do something very silly.
Got it. Okay, I'll not ask you for your theories on telecom. Those are defined, well known. Your positioning speaks for themselves, and I mean, virtually a monopoly business or a duopoly business. So fairly straightforward. Though I think one of the companies is having a good international presence as well. But since I have time for 2 questions, I'm going to split them up, one global and one local.
Okay.
The local question, Kenneth, is where do you see the risk for this market being global in nature, or could it be lack of earnings growth, etc., which could drive the markets lower? I mean, the policy intent is out there, both monetary and fiscal. Can the market still come down because of a local factor, or would it need a global factor to bring it down?
So you already had a stress test which is as early as 2020, right? We missed almost 4 months of sales. Okay, and in those 4 months of sales, corporate India actually tightened up their belt, raised capital, lowered debt. Okay, absolute debt, not in debt equity. The absolute debt actually came down. So to say that someone's going to have a panic attack and all will go down, I mean, I find that a little hard to believe, though I don't rule out anything. I'm not going to say this time is going to be different. Okay, so that could happen, but it has to come from a lot of factors. If it's just going to be earnings and growth, okay, then you got a consolidating market. Nothing's going to happen.
Got it.
But if you have somewhere a shock shock the system, which markets plummet vertically, I don't think it's going to be a existential risk for investors or for capital markets. So whatever has happened in the cycle, the smaller companies doing well, smaller companies doing well by market cap and has got no underlying earnings to it, I don't think there's a risk now really to that trade. Though I don't want to call it, don't want to say that everything is hunky-dory. There will be companies that will go out, there'll be systemic frauds or systemic risks that will turn up. But From a capital market investor standpoint, I wouldn't worry about it so much.
Okay. Are you in the camp which says, oh, SMIDs are dangerous and therefore avoid SMIDs? And no, right?
So these are market cycles, right? 2013, 2014, the only place you should have invested in was small and mid caps. Okay. 2017, the only place you shouldn't have invested in small and mid caps, right? Then 2020, the only place you should have invested in was small and mid caps. Okay. Today, nothing exists. Okay, so my sense is if 80% of your entire market in 2020 had was investable and all of them were in small and mid caps. Today the case is not so. You might just find 10% or 20% of the companies which are in that right framework. So yes, from a so if I was running a 200,000 crore portfolio, I would definitely say out there don't invest. I wouldn't invest in that basket at all. But we don't have such problems.
One last question, Kenneth. A lot of people talk about forget de-dollarization, too steep a term, maybe a too long drawn, whatever. And that's a different argument. But that if the market was completely skewed the last 15 years towards investing in US assets as a percentage of the world market cap, that may change, and that brings in opportunities for emerging markets, Asian markets like India to get in global flows. Are you of the belief, and what the factors there could be? Could it just be simple moving away from the US for a little bit, or are there other factors here?
So if you have to buy a currency, don't buy the dollar. Which is if I had to answer the question differently. Okay, but if you have to buy high quality, high growth businesses that are there, which basically have no valuation parameter at this point in time, the US is the only place where you can buy them. Okay, what gives you access to technology apart from the US? You obviously have a company or two or three in different parts of the globe, but not everywhere in the world. So yes, the US can't be ruled out. It always comes back, and it always comes back because it leads technology, because they have the kind of people and the quality and the DNA to do it. So yes, but if you have to buy a different currency, okay, you obviously have to move away from the dollar. So not really the market, but if you have to buy a different currency, you have to move away from the dollar.
But not the market. Well, point noted. Kenneth Andrade, thank you so much for taking the time and being with us. Absolute delight.
Super. Thank you very much, Neeraj.
And viewers, thanks for tuning into this episode of Talking Point Unfiltered.